Does it meet the 1% rule? That's the big question. And the answer is, who cares? The 1% rule is dead. If you're still using it to judge rental properties, you might be sabotaging your long-term wealth. Here's why the math doesn't add up anymore and why thousands of investors are walking away from opportunities that actually outperform the old model. So what is the 1% rule? It's been around for decades now. When I first went into real estate 27 years ago, this was the marker we were told to look at. And basically what it meant was if you could get a home for $100,000 and get $1,000 rent, that would be the 1%. You'll be receiving 1% of the sales price in rent every month. And basically that was a marker to say, if you could get that, you'd be able to cover your costs and reach some cash flow from hitting this 1% rule. But that shortcut used to be true in certain markets, but in today's economy and with the new type of properties available for investors, it is dangerously misleading. Okay, the first reason 1% rule is outdated because it used to be based off of older construction homes. Now, these homes needed serious amounts of repairs, and they always seemed to have higher maintenance and more expensive turnover costs. Now, let me take these one by one. First of all, the repairs to get that property up and going so it's tenant ready, those normally weren't included in the 1% rule. So if you're buying the house for 100, but you have to put 30 into it, then you're above the 1% rule. A lot of times people were doing the numbers wrong with that. But not to mention, not only high repairs going in that could throw off your numbers, but there's also maintenance costs. I call it the 3-year curse. See, I've done over 2,000 rehabs and built thousands of new construction homes. And I've seen the costs side by side with each other. And what we realized with older homes compared to new construction, there's something called a 3-year curse. Now, let me explain what the 3-year curse is. 3 years in on a new home that I've rehabbed and put on the market, put with a tenant, it seemed by year 3, I would always have to budget for higher maintenance and repairs costs, more so than with my new construction. That's why we call it the 3-year curse. Didn't matter if I did new roof, heating, cooling, plumbing, update kitchens, electrics, baths, everything. By year 3, I normally see a jump in my maintenance costs, which can really eat into your cash flow. With new construction properties, we haven't seen that. And that's 7, 8, 9, 10 years down the road on the newer construction homes because they're built a certain way to a certain newer standard. So maintenance and repairs are a huge thing that throw off the 1% rule. That's not calculated in. The other things are turn costs. Now, when a tenant moves out of your property, you have to turn the property over. It's called a turn cost to get it ready for the next tenant. What we saw was our average turn cost dropped by over 80% to turn it between one tenant and another. Again, this is just something we saw with the older construction homes. No matter how well I renovated them, I just wasn't able to get these lower turnover costs. The turnover costs were always higher. With new construction homes built to a certain level, we were able to reduce those costs by over 80%. Another reason why the 1% rule has been outdated is because you have to look at the type of properties, again, you are using. With the older homes, we were getting an average stay of about 13 months. Now with new construction homes, you're getting about a 3-year average stay. That's a huge difference in stability for the numbers. And it means fewer headaches, less vacancies, and more consistent cash flow in those first few years. And those first few years are absolutely pinnacle to the success of your property or not. So again, if you're having less maintenance and repairs, you're having less turnover costs, and a tenant is staying for a few years instead of just 1 year, that again throws the 1% rule marker that used to be the standard on older homes out the window. And if people don't recognize that, they're leaving great opportunity on the table. So another reason that the 1% rule is really failing people today is the misconception around insurance. Now, a lot of the times when people were following the 1% rule, including me when I first started as an investor, was I was buying older fixer-upper homes. Now, if you're looking here where I'm building homes in Florida, older homes can be looked at entirely differently when it's coming to getting the right insurance on them. They're built on lower ground, they're built with less structural integrity, and that's just something you take over with an older home. And you can pay the price severely when it comes to insurance. Some of you have watched my other videos where I put one of our new construction homes side by side with one of my older owned homes. The actual insurance premiums can go up 5 to 7 times more on a smaller, older home that's more inexpensive. And when you start to add in that insurance and it takes down your cash flow, well, the 1% rule again goes out the window. But properties like new construction that are underperforming the 1% rule, but getting much cheaper insurance can make up that shortfall. So it's an absolute crossing of the lines that wasn't even an issue 10 years ago. Now, especially in the Florida area, there is a huge difference between insuring a new construction home for very cheap, maybe $65 to $100 a month, compared to an older home that might have deferred maintenance built on lower ground. And again, those insurance costs could be 5 to 7 times more than the monthlies on a new construction home. That right there is going to confuse you. If you're looking at just the 1% rule and you say, hey, great, this older home is cheaper, it fixes everything, but my insurance is this much more expensive, it will eat up your cash flow and reverse the market that it used to be. And overall, with the 1% rule, whether it's the 1% rule, whatever you're looking for wealth. And most of my wealth in the last 27 years, when I've looked at my portfolio and owning hundreds of properties, it's come from appreciation, holding long-term in the right properties in the right market, that equity growth, not 1% cash flow properties. Cash flow is great, but equity, appreciation is what has created the multi-millions for myself. And chasing the 1% rule might feel good in year one, but let me tell you, it can leave you broke by year 7. And why could it leave you broke by year 7? Well, I've experienced this. Other investors have, where there's properties that we got into because they were cheap, but we couldn't see all the actual repairs. We didn't estimate for the higher maintenance, the higher turnover costs that were going to happen with these types of properties. And when you don't calculate right for those, you don't even have time to go through the market fundamentals where long-term growth can happen. You can get eaten up on maintenance, repairs, extra turnover, and those things are absolutely detrimental the first 3 to 5 years of owning a rental property, something you want to avoid. That's where the 1% rule steered me wrong, because I was buying lower end properties than I should have, looking at just that one marker, but not really seeing all the repairs, not really seeing all the maintenance, not seeing the higher turnover costs compared to my newer construction properties of today. So combining all those things, they will eat into your profits faster than you realize. Now, another thing I hear all the time, the industry narrative, I heard the 1% rule still works for disciplined investors. Sure, it works if you ignore maintenance, tenant churn, and long-term returns. In the real world, that shortcut does not hold up. I cannot stress enough. And again, I've tested it with thousands of older fixer-upper homes and new construction homes. That 1% marker did not protect me from the higher repairs, the higher maintenance, the higher turnover. And now in today's day and age, especially here in Florida, the higher insurance. Again, that is a major difference in cash flow and stability of your property. If you have to buy a cheaper property, but pay 5 to 7 times more for your insurance, that can really reverse the gears quick and take away the profits you're trying to make. So you're probably seeing this is why we don't ever offer old homes anymore. We know that new construction outperforms the old fixer-uppers, and we don't ever want to put our clients into properties that underdeliver for the long term. You have to remember, we've done thousands of old fixer-uppers, but over the last decade, we've only stuck to new construction homes. The reason why, yes, there's still people that are going to offer them out there, gurus and people you might be following, podcasters. What we've seen, though, is the older homes in tougher areas are a lot of things that are pitched to out-of-area investors, and it feels good to buy one. They're cheap, the down payment is really affordable, and you feel like you're going to build up a massive amount of homes more quickly. The problem is those homes might not deliver because of all the issues I'm talking about. That 1% rule that made the promise and was supposed to keep you safe, well, if you have that extra repairs, extra maintenance, extra turnover, higher insurance costs, these things can really eat into your profits, and you're exhausted by year 3. You're exhausted by year 5, and you throw up the white flag, and you usually cash out at a loss. We don't want to see that happen to you, so we only stick with the new construction because we want the long-term buy and hold. That one strategy that's made more millionaires, I think, than any other strategy in the U.S., and that's what you want to stick to. You got to have the right type of property. That's going with maybe sacrificing the 1% rule, but sticking with a better quality property in a better area. So if you're an investor, stop chasing the 1% cash flow shortcuts. If it's a fixer-upper home in a tougher area and you're just looking at cheap price and a pro forma that may not even play out in the first few years, and I can tell you, knowing, because I've owned a lot of them, extra repairs, extra maintenance, extra turnover, and in Florida, much higher insurance costs, this can really work backwards for you. So focus on quality neighborhoods, longer tenancy, better properties, in long-term equity growth. It shouldn't be what's happening over the next 6 months. I like to look what's going to happen over the next 7 to 10 years with my properties. In order to really get that established, you got to have the right type of property. If again, just focus on the 1% rule, well, you might get caught behind the lines with those more difficult properties in tougher areas with larger costs than that performer promised you. And if you're a builder, educate your clients away from the 1% myth. Believe in what you're doing. From what we've accomplished over the last decade, we've been able to see this with a statistical certainty that if you are offering a property that's new construction with warranty in a better area, but it's a little below the 1% rule, but the tenant's staying longer, there's less maintenance repairs, the insurance is much cheaper, we can absolutely outperform that pro forma that people are receiving for an older fixer-upper property that's hitting the 1% rule. You got to position yourself as the trusted advisor on this. And this isn't just something that we're saying. This is something that some of the biggest institutions in the world are doing, and they're taking a lot of money off the sidelines right now to only invest in new construction properties, right? Post 2008, these institutions, when they were buying up properties, were buying older fixer-uppers. But after doing the math, and they own thousands and thousands of these, they saw that the new construction homes were a much better bet, even though they were a lower promised amount than the 1% myth now. They performed longer and they could stick with them with less headaches and more long-term sustainable growth. So the investors who win over the next 5 to 10 years will not be the ones who chase outdated formulas. They're the ones who are going to have staying power. They'll be the ones who own properties in stable neighborhoods with lower maintenance, longer-term tenants, lower insurance costs, and equity growth that compounds. 1% rule was a great marker to get me started in my real estate investing career. But as I've evolved and changed over the years, I again have the motto of saying I will own less of better quality. And I know that gives me long-term visibility, more stability in ups and downs times, and creates more wealth for me. So the 1% rule was a great starting point. It's become outdated. And now it's up to you to see how you want to build your real estate portfolio. Do you want it working for you? Or do you want to be constantly in the trenches with more maintenance, repairs, turnovers, fighting with insurance companies who are charging 5 to 7 times the amount? I think you know the direction you want to go. So if you're ready to play the long game in real estate and not just chase these outdated shortcuts like the 1% rule, stick around. We're going to keep breaking down the myths that are holding investors back today.